Ever wondered if investing in gold is a good idea? Or how does one even start investing in gold? Well, let's dive right in. Investing in gold is more than just buying shiny trinkets. It's about putting your money into something tangible, something that has held its value across civilizations and centuries. Gold investment can be a great way to diversify your portfolio, hedge against inflation, and safeguard your wealth during economic downturns. Why? Because gold is often considered a safe haven asset. When stock markets are volatile, investors often flock to gold as a more stable store of value. However, like any investment, gold comes with its own set of risks. Its price can fluctuate and it doesn't produce interest or dividends like stocks or bonds. But that doesn't mean it's not worth considering. So if you're intrigued and want to start investing in gold, then this guide is just for you. Before diving into the how, it's important to understand why you should consider investing in gold. Gold has been a symbol of wealth and prosperity for centuries. It's not just a shiny metal that people like to wear as jewelry, it's much more than that. Gold is a tangible asset, a physical commodity that you can hold in your hand. And this tangibility gives it a sense of permanence and stability that few other investments can match. One of the primary reasons people invest in gold is as a hedge against inflation. When the cost of living rises, the value of money falls. But gold tends to maintain its value over time. In fact, during periods of high inflation, the value of gold often increases, providing a safe haven for investors who want to preserve their purchasing power. Gold is also a reliable store of value. Unlike paper currency or digital assets, gold doesn't rely on a third party for its value. It's not subject to the same risks as bonds or stocks, like company performance or government stability. Its value is intrinsic. It's been valuable to humans for thousands of years, and that's not likely to change anytime soon. Adding gold to your investment portfolio can also provide diversification. It's often observed that when stocks go down, the price of gold goes up. So having a portion of your investment in gold can help balance out the risks associated with other investments. It's a way of spreading your investment eggs into different baskets, so to speak. However, like any investment, gold isn't without its risks. The price of gold can be volatile in the short term. It can go up and down like any other market. But over the long term, gold has consistently held its value and even grown. In essence, gold can be a solid investment strategy if you know how to do it right. It's not just about buying gold and hoping for the best. It's about understanding the market, knowing when to buy, when to hold, and when to sell. It's about having a strategy and being disciplined enough to stick to it. And that's what we're going to talk about in the next scene. Now that you know why to invest in gold, let's explore the different ways you can invest in it. There's a golden array of options to choose from, each offering a unique blend of benefits and challenges. First up, we have physical gold. This is the most traditional way to invest in the precious yellow metal. It involves buying gold in tangible forms like coins, bars, or jewelry. The allure of physical gold lies in its tangibility. You can hold it, feel it, and store it. However, it also comes with storage and insurance costs, and there's always the risk of theft. Next, there's gold ETFs, or exchange-traded funds. These are funds that track the price of gold, and you can buy and sell them just like stocks. They offer a convenient way to invest in gold without worrying about storage or insurance. But remember, with gold ETFs, you don't actually own the physical gold. You own a share of a fund that owns gold. Gold mining stocks are another option. When you invest in these, you're essentially investing in companies that mine gold. This can potentially offer higher returns if the company performs well, but it also exposes you to the operational risks of the company. Lastly, we have gold mutual funds. These are funds that invest in a mix of gold-related assets like gold mining stocks, gold ETFs, and sometimes physical gold. They offer diversification and are managed by professional fund managers, but they may have higher fees, and you're also relying on the fund manager's expertise. Remember, each method has its pros and cons. Physical gold offers tangibility. Gold ETFs offer convenience. Gold mining stocks offer high potential returns. And gold mutual funds offer diversification. But they all come with certain risks and costs. So it's crucial to choose the one that aligns with your investment goals and risk tolerance. Whether you're a risk taker looking for high returns or a cautious investor seeking a safe haven, there's a golden opportunity waiting for you in the world of gold investment. Now on to the exciting part, how to actually start investing in gold. To the uninitiated, investing in gold can seem like a daunting prospect. But fear not, with a little knowledge and a systematic approach, it can be quite straightforward. Let's break it down into manageable steps. Step 1, do your research. Just like any other investment, you need to understand what you're getting into before you start. This means learning about the different ways to invest in gold, the potential risks and benefits, and how the price of gold is affected by economic and geopolitical events. There are plenty of resources available online, so take your time and learn as much as you can. Step 2, choose your investment method. There are many ways to invest in gold, from buying physical gold bars or coins to investing in gold ETFs, exchange-traded funds, gold mining stocks, or gold certificates. Each method has its own pros and cons, so you'll need to decide which one is right for you, based on your investment goals, risk tolerance, and available capital. Step 3, decide how much to invest. As a general rule of thumb, financial advisors often suggest that gold should make up about 5 to 10% of your investment portfolio. This can help to diversify your investments and hedge against potential downturns in the stock market. However, the right amount for you will depend on your individual circumstances and investment goals. Step 4, make the purchase. Once you've decided on your investment method and how much you want to invest, it's time to make your purchase. If you're buying physical gold, you'll need to find a reputable dealer. If you're investing in a gold ETF or gold mining stocks, you can do this through a brokerage account. Finally, step 5, monitor your investment. Investing in gold isn't a set-and-forget strategy. You'll need to keep an eye on the gold market, monitor the performance of your investment, and adjust your strategy as necessary. Remember, investing is a long-term game, so don't be disheartened if you don't see immediate results. In conclusion, starting to invest in gold involves doing your research, choosing the right investment method, deciding how much to invest, making the purchase, and then monitoring your investment. It may seem complex at first, but with a bit of patience and perseverance, you'll soon get the hang of it. With these steps, you're well on your way to start your gold investment journey. So, let's quickly recap what we've learned today. We kicked things off by introducing gold investments, a time-honored form of wealth preservation that has dazzled humanity for thousands of years. Investing in gold is not just about the allure of the shiny metal, but it's also about the security it provides. Gold's value tends to remain stable or even increase during economic downturns, making it a reliable hedge against inflation and currency fluctuations. From there, we moved on to explore the different ways you can dip your toes into the sparkling waters of gold investment. Gold comes in many forms, each with its own set of advantages and challenges. Physical gold, such as bars and coins, offer the benefit of tangible ownership, but come with storage and insurance considerations. Gold ETFs and mutual funds, on the other hand, provide a more accessible route for those who prefer the liquidity and convenience offered by these financial instruments. Then there's gold mining stocks and futures contracts for the more adventurous investors willing to take on a higher degree of risk for potentially greater returns. Finally, we walked you through the steps to start your golden journey. First and foremost, it's crucial to understand your financial goals and risk tolerance. This will guide your investment strategy and help you decide which form of gold investment suits you best. Then, do your due diligence. Research about different gold investments, understand their pros and cons, and keep an eye on gold prices and market trends. Armed with this knowledge, you can then decide where to buy your gold, whether it's from a reputable dealer, a trusted financial institution, or a well-regarded online platform. Remember, investing in gold can be a great way to diversify your portfolio and protect against economic uncertainties. So take your time, do your research, and start your investment journey wisely.